Think of a bond fund that dares to chase yield where credit ratings fear to tread. That's JNK, the SPDR Bloomberg High Yield Bond ETF right now. We'll unpack its design and by the end, hand you a quick test for deciding if JNK fits your strategy. JNK tracks the Bloomberg High Yield Very Liquid Index, holding US dollar corporate bonds graded below investment grade, but large and frequently traded. At least 80% of assets mirror the index, so performance stays glued to the high-yield market, while the ETF wrapper lets you trade in seconds. Bonds must have at least $600 million outstanding, so the fund can transact at scale, even during volatile markets. What lives inside? About 23% comes from consumer-cyclical issuers. Think autos and retailers. Telecom and media add roughly 18%. Energy, 17%. With double-digit helpings of consumer staples, capital goods, and technology rounding out the mix. Most bonds mature in 3 to 5 years, giving the fund a moderate duration that cushions price swings compared with longer-dated debt. Most holdings sit in the BB to B rating range, with only a modest slice in the riskier CCC tier. Geography is straightforward. Close to 90% of issuers sit in the United States, while Canada, the United Kingdom, and a handful of other developed nations fill the rest. Every bond is denominated in US dollars, removing currency volatility inside the portfolio, though non-US holders should remember their local currency still moves against the dollar. Who should consider JNK? Investors hunting higher income than they can get from government or investment-grade bonds, yet unwilling to jump fully into equities. It suits diversified portfolios that already own low-risk fixed income and want a spicy slice to boost yield. Because defaults rise in recessions, holders need medium risk tolerance and a multi-year horizon. Here's a practical playbook. Use JNK as a plus allocation, maybe 5 to 15% of the fixed income sleeve, bolstering yield without letting credit risk dominate. Rebalance at set intervals. Spreads widen fast when growth slows. Tactical investors can overweight when credit metrics improve, then trim when default warnings appear. Daily volume tops millions of shares, keeping trading costs low. Holding hundreds of bonds softens the impact of any single default. Now the promised test. 3 quick checkpoints. 1. Yield versus option-adjusted spread. If the spread doesn't pay for potential defaults, wait. 2. Sector health. Consumer cyclical and energy issuers account for $4 and $10, so watch retail sales and oil prices. 3. Duration versus your rate view. With a lifespan around 3 years, JNK benefits if central banks cut sooner than expected, but still hurts if yields spike. Pass those checks and JNK can be a disciplined, liquid route into the global high-yield arena. Fail them, and you're better holding safer bonds until conditions improve. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at MoneyNova's website. Thanks for staying until the end. For more concise guides to ETFs from every corner of the market, subscribe and turn on notifications. Your next smart portfolio move could be one video away.